In this video, I'm going over the 3 dividend-paying stocks I'm buying right now. These are stocks that pay out a dividend that grows each and every year, and I plan to hold for the long term. All 3 of these companies are blue chip established names that I think are only going to continue to grow revenue and income over the long term. So I'm going to go over the 3 different companies, take a look at their current share price, their current dividend, the dividend growth rate, and some key financial stats and share price predictions over the next year. So if you're new to the channel, everyone, I am the Gen Z investor, and every single day we talk about the stock market. We go over different stocks you can buy and sell and discuss any major stock market news or headlines. So please hit the like button, subscribe to the channel for daily videos about the stock market, and today we're focusing on the 3 companies that I just bought for my personal dividend growth portfolio that currently sits at a value at $78,000. I added to 3 existing holdings within this portfolio over the past 2 weeks. I couldn't find any new companies I wanted to add in, so I thought it was best to put my capital to use into blue chip names that I already own and plan to own for at least the next decade. So this is my financial freedom portfolio, currently values at $78,000, and we're up close to 12% over this year. And if we take a look, this portfolio pays me around $1,879 per year in dividend income. And every single time I buy more dividend stocks, this annual dividend income goes up, and every single time one of these companies raises their dividend, that grows as well. So this provides me a couple $100 per month in passive income, and I do like this portfolio. I think it's holding up very well, and these 3 new additions, these 3 new added purchases to my existing holdings, I believe is only going to accelerate the growth over the long term. The first stock I bought more shares of was JP Chase. I got in around $119 per share, so very close to where the share price sits today. The company is down 13% this year, and I'm still bullish on the financial sector. The pandemic was supposed to end the financial sector as we know it. We thought all major banks were going to get destroyed, and we were very worried about the health of our financial system. But right at the beginning of the pandemic, the Fed made the banks pass a stress test, and JP Morgan passed. A couple of the other main banks passed as well. So it just showed that these banks were actually healthier than expected. And over this pandemic, over the past 3 quarters, these banks have been heavily fortifying their balance sheets. They were not allowed to raise dividends, and they were not allowed to do share buybacks. They were really bolstering up their capital position just in case it got worse. But that really hasn't happened. And we got great news from the Fed that is allowing the major banks to actually conduct share buybacks in 2021. There are some restrictions, but minutes after this news came out that the Fed will allow the large banks who passed the second stress test to do share buybacks, JP Morgan announced a $30 billion share buyback program for 2021. And once this news came out, if we take a look at the after hours trading, JP Morgan stock has jumped over 6%. So I think this is huge news for the banks. And if the Fed allows this share buyback program to begin next year, I think they understand that the actual pandemic wasn't as bad on the financial system as we were expecting, and the banks are healthy enough to maintain operations. A quote from JP Morgan CEO Jamie Dimon, who I am personally a big fan of, he just said after this announcement that we will continue to maintain a fortress balance sheet that allows us to safely deploy capital by investing in and growing our businesses, supporting customers and businesses, paying a sustainable dividend, and returning any remaining excess capital to shareholders. That's what I like to see. They want to, of course, focus on their business, maintain that safe balance sheet, which we all know and expect. But one thing I like to point out is banks are known for returning investors with capital in the form of a dividend and share buybacks. And that's exactly what he said, paying a sustainable dividend and returning any remaining excess capital to shareholders. That's what I like about banks. That's what I like about the financial sector. And I'm still very bullish on this company. And I'm lucky to see my position will grow at least a little short-term 6% bump up from where I hold them today. Now we're going to take a quick look at some analyst expectations for JPM before moving on to some financial info. So if we take a look, the price target for their stock is $124 over the next 12 months. Considering the company has actually surpassed that level from the after hours trading in the gain of 6%, I think this is a very low and bearish expectation of the company over the next year. I think they will have a positive year into 2021. I think loan losses are not going to be anywhere near expected, and I think the company will continue to grow, and I do think this share price prediction is on the low side. If we take a look now, the company is still considered a buy. 2 strong buys, 15 buys, 8 holds and 2 sell, but an overall buy consensus for JPM. And over the past 6 quarters, they've beaten earnings per share estimates by a significant amount 5 times, and their one negative surprise was at the height of the pandemic when they were expecting massive loan losses. They had huge loan loss provisions bringing down their net income and their EPS. But you can see in the 2 quarters following that, they have absolutely destroyed analyst expectations by more than 30%. And Yahoo Finance predicts that JPM will grow 21% next year, which I think is a more accurate growth rate for the company, especially coming off this rebound from how hard 2020 was. And moving forward, if we take a look at some key financial stats, over this latest quarter, even during 2020, when the pandemic is still roaring, they actually posted positive year-over-year revenue growth. It is small at 2.7%, but earnings also grew 4% in a year where we have a pandemic that is destroying the banks. So I think it was absolutely incredible to see that this company was still able to grow over this latest quarter during this point in time. And the company also has some very nice profit margins coming in at 26%. If we take a look at their actual financial statements, their total revenue has been growing year over year, which is absolutely incredible. Not massive growth, but you can see an upward trend over the past 4 to 5 years. And over this year, of course, we have seen a slight pullback, but still bringing in $98 billion of total revenue. Taking a look at their bottom line, you can see the huge amounts of net income JP Morgan brings in. Before this pandemic in 2019, they brought in $36 billion of net income, which is absolutely incredible. Of course, similar to revenue, I'll pull back over the past 12 months, but still this company is bringing in over $2 billion of net income per month over the past year. And taking a quick look at their balance sheet, we can see they are actually the largest bank in North America with regard to total assets. They have $3.2 trillion of total assets on their balance sheet. Overall investments continue to grow, and a lot of people weren't spending that much money because of the pandemic, and because they were spending more time at home, they had more money to put into the bank, deposits increased, and banks had more capital to invest and grow operations. And if we take a look at the dividend, because we all know I'm a dividend growth investor, JP Morgan's current yield is 3%. They only pay out around 47-48% of their earnings as a dividend, so I think it's at a very sustainable rate to continue to grow and grow the business. And as well, they grow their dividend at a rate of 16% averaged over the past 5 years. They will not grow their dividend this year because of the Fed's cap on dividend growth, but I do think once they are allowed to grow it, they will, and I think that trend of upward dividend growth will only continue over the long term. And this company's dividend safety score is coming in at 60. It is considered borderline safe, but I don't think that's very accurate anymore. I think this rating came earlier in the year when the pandemic was still roaring, but now that we got this positive news from the Fed that they are allowed to do share buybacks, the company has a beautiful balance sheet. I think revenue is only going to continue to go up over the long term. I think the dividend is safer than 60 and borderline safe. So JPM was the first company I added over this past week. I already had a decent position in this company, but I'm still bullish. In my personal opinion, this is the best bank in North America and within the United States. So I want to add more to this position at a point in time where I think the share price was attractive. I do think not too long in the future, we will see the share price hit new highs and surpass this $138, $140 share price we saw earlier in 2020. Moving on to the second stock I bought this week, it was Merck, ticker MRK, currently trading below $80 per share, and this company is still down 10% this year. This is a healthcare giant with a market about $200 billion and pays a very nice and very safe 3.2% dividend yield. And the company currently trades at a nice valuation at a forward PE of only 13.3. And on the 52-week range, you can see trading towards the center. So I thought Merck was at a very nice and attractive share price to get in and add to my existing position. Their 3 main drugs that really help drive revenue have continued to see some strong sales throughout 2020, and analysts still have this company as a buy. They expect the company to continue to grow, and their dividend growth has been insane over the past 2 years as well. The price target over the next 12 months for Merck is 20% expected growth to hit around $96 per share. So a ton of potential upside if we can see the share price hit this mark. And if we take a look, the company is rated as a buy. No one is selling out of Merck right now. We have 6 strong buys, 11 buys, and 5 holds, which is a great sign to see. Over the past 6 quarters, beautiful, beautiful results. 5 huge positive earnings per share surprises and only 1 in line that they still beat by 1%. And one thing I want to point out, over 2021, we're expecting 10% revenue growth from this healthcare giant. So insane numbers that I love to see. And if we take a look now at some financial stats, they have a profit margin of 24%, operating margin of close to 33%, and massive return on equity at 41%. So absolutely incredible. And over this latest quarter, they posted quarterly earnings growth of 54% year over year. So even during a tough pandemic-ridden year, earnings continue to grow by a massive rate. And taking a look at some balance sheet stats, they have around $7.3 billion of cash on the balance sheet and a current ratio of 1.3. So a current ratio nicely above 1, very safe balance sheet over the short term. If we take a look now at Yahoo Finance predictions, over the next 5 years, we're expecting share price growth of over 7.2%. Add in the dividend, we're expecting at least 10% annual growth from Merck. The company right here you can see is directly rated a buy, and the price target shows some significant upside. The current price target right now for the stock is $95 per share over the next year, but if we take a look, the current price sits at $79 all the way down here. So a ton of upside to hit this price target next year. And taking a look at the dividend, that's what really drives me to this type of holding. Nice 3.2% dividend yield, so a nice average yield, payout ratio of only 43%, extremely sustainable, and they grow their dividend at 5% per year. I like owning companies who grow their dividend between 5 to 10% plus per year, so it is on the low side of my average dividend growth rate, but still a 5% annual raise in your passive income is not too shabby. And take a look, this is what really drives me to them. Their dividend safety score is considered 99, the highest possible. So that's considered very safe. I'm absolutely not worried whatsoever of a dividend cut coming anytime soon from Merck over the short or long term. So this was the second company I added into. I thought it was at a great price. I think the share price has a ton of room to grow. It's still down 10% this year when a lot of other healthcare giants are recovering. For a company with a $200 billion market cap, revenue is expected to grow by 10% plus. I just think there's a lot of strong future growth over the next few years for Merck, so I added into my position over the past few weeks. Now on to the third company I bought more shares of, we have Costco. I think they're one of the best retailers within North America, currently trading around $367 per share. The company has grown 25% this year, but you can see a slight pullback from their most recent high over the past few weeks. They have a market cap at $164 billion and a current dividend yield at 0.76%. The share price has grown to 25% this year, and over the past 5 years, share price is up 130%. So this is more for the share price growth, of course. The dividend coming in at less than 1% isn't extremely attractive, but I like overall returns from my dividend growth companies. And one thing I like about Costco is every few years they do come out with a nice special dividend, like they did over the most recent quarter of the $10 per share payment. So the company does provide investors with nice capital growth and nice dividends over the long term. And one thing I like about Costco, with the fear of a potential lockdown coming in place, they are the store that people rush to stock up on goods. They provide bulk items, and Costco is known for getting flooded whenever the risk of a lockdown comes out. So I think Costco is going to have another great fourth quarter of 2020, and because they provide consumers with necessities, no matter what's going on in the economy, they remain open and operational. I know we've discussed that on the channel before, and that's one of the main drivers I believe that will help Costco continue to succeed over the long term. Now, if we take a look at the analyst report, they expect Costco to grow by just over 8% over the next 12 months. Again, I think that is a little bit of a bearish expectation, but I think they will perform at least 10% plus share price growth over the next year. If we take a look at the buy rating, we see 8 strong buys, 13 buys, 11 holds, and 1 strong sell. I don't know what this analyst was thinking, but I do not agree whatsoever with this strong sell rating. Company is currently rated a buy, and that I do agree with. Over the past 6 quarters with regard to earnings per share, we've seen a few positive beats, a few in line with expectations, and the one negative surprise came at the height of the pandemic, and it was only a 3% miss, so I'm not too worried about that whatsoever. One thing I like to see is over 2021, we're expecting close to 10% annual revenue growth, and in 2022, we're expecting 17% annual revenue growth in that calendar year. So huge expected numbers from Costco going forward. Taking a look at their financial stats, Their profit margin is very low, but that of course is very similar to other retailers in the industry. Return on equity at 27.8% is very high, and they're able to see some beautiful revenue growth of 16% year over year, and earnings per share growth. Earnings growth grew 38% year over year, which is great to see. The company has total cash on the balance sheet right now of $14.4 billion, and they have total debt of $10.2 billion. If we take a look at the average price target from Yahoo Finance, you can see that right now the company is considered a buy. You can see a 2.2 rating, very close to that buy, and the average price target over the next year is $400 per share, so significant upside from the $367 we sit at today. If we take a look, total revenue for Costco continues to grow nicely year over year, and they continue to reach all-time highs as time goes on. And like we saw from the analyst report, we're expecting 10% annual revenue growth next year, followed by 17% in 2022. The current dividend sits at 0.76%. The payout ratio is extremely tiny though, of only 28% of their earnings. They grow their dividend at a massive rate, averaging 14.5% annual dividend growth. And their dividend safety score is the highest possible at 99. So not worried about a dividend cut. And with a low beta of 0.61, not a lot of share price volatility from Costco. So this was the third stock we bought into over the past 2 weeks. The company, I believe, is at a nice valuation. I think they will continue to grow. Although the share price is close to the 52-week high right now, they have seen a little bit of a pullback over the past month, and I will be buying more if the share price continues to downtrend. So thank you for watching, everyone. Those are the 3 companies I bought into this portfolio over the past few weeks. I contribute capital to this portfolio at least once or twice per week. I make small continuous deposits. I like just knowing that my capital gets deployed into this portfolio to invest in strong blue chip dividend paying companies. So like we saw today, I bought more of JP Chase, Merck, and Costco. 3 companies I plan to hold for the long term, and I think their dividends will compound very nicely, providing me with some beautiful annual passive income. So thank you for watching, and see you in tomorrow's video.